Chris Jones here with the next video in our 24 rules for a successful business exit. If you like these videos, please like and subscribe. During rule number 8, we shared that all cash deals are rare. Often the seller will receive payments over time. When you hear business sellers say they have to carry paper, this is what they're referring to. The fact is, not all businesses and not all buyers will qualify for SBA loans. Any significant changes in revenue or earnings can make those loans harder to secure. For a buyer you really like, with the proper security, seller financing a portion of the price may be attractive. But like anything, it's important to know the upside and downside of using seller financing, which is the focus of today's video. Rule number 20, understand the pros and cons of seller financing. So let's begin with the pros. The first pro is seller financing increases your pool of buyers. Most Main Street business buyers have 10 to 30% for a down payment and rely on SBA financing for the remainder. If the business isn't a good candidate for SBA financing, that leaves seller financing as the most viable option in many cases. It allows the seller and buyer to be far more creative with deal terms than a bank would ever allow. The second pro is buyers see deals with seller financing as less risky. Seller financing signals to the buyer that the seller believes in their business. You put your money where your mouth is and ease buyer concerns about the future success of your business. And when buyers see less risk, along with decent growth opportunities, they tend to pay more. The third pro is a significant amount of interest income. Remember, when you seller finance, you are the bank. And like a bank, you'll charge interest. Here's a chart showing the total interest paid per 100,000 on interest rates of 6 to 9%. On every 100,000 you finance, you can make over $45,000 at an 8% rate. That's a 45% return on your money. Our fourth pro of seller financing is a more expedient and potentially less cumbersome due diligence process. Deals that involve banks generally take more time, as our risk teams have to carefully vet each potential loan. This can add months to the process. Seller financing removes the bank from the process, reducing the time to close. We've been part of deals that have closed in as little as 60 days from start to finish. Our fifth and final pro is the potential for tax benefits. Seller financing typically involves spreading payments over a 5 to 7 year period, so your year of sale taxable income doesn't spike dramatically. This can result in tangible tax savings. Now, seller financing isn't all sunshine and rainbows. You have to be aware of the potential downside, so let's cover the cons. The first con, of course, is risk. There's a chance the buyer can default on payment obligations. The buyer turns out to be a poor business person, they could ruin the business. This is why it's important to vet your buyers properly and secure the loan. Think like a bank. Is the buyer a good fit? Do they have transferable experience? Do they have working capital to support the business? The second con is less immediate capital from the sale, which you could use for another opportunity. You may receive only 20 or 30% of the sale price at closing, so you'll have less capital to make bigger purchases like a primary or secondary residence for retirement. Now, you need to really decide how much cash you need at closing for living expenses, debt payoffs, and your goals. If the business has a lot of debt to pay off, this may not be a good option for you. We've covered some of the pros and cons of seller financing. If you want to learn more about this topic or how to value your business, you can check out more of our videos here or give us a call anytime. I'll catch you in the next video.